Hello and welcome to another discussion on Investment Yogi. My name is Ishwari. Can you guess what it means? It means goddess. Pretty simple, huh? But here are some names that are not so simple, like HSBC Advantage India Fund. Sounds like a game of tennis in progress. Fidelity India Special Situations Fund. What is that? The ING Lion Fund and the DSP Tiger Fund? I mean, is this a part of the World Wildlife Fund? No, you guessed it. I'm talking about mutual funds. There are so many mutual funds in India now with such confusing names that it can leave a new investor in a tizzy. So let's begin at the beginning and understand what mutual funds are. A mutual fund is a company that pools investors' money to invest in various financial securities based on a common financial goal. The individual investors become shareholders in the company in proportion to their contribution. When there are profits, the investor earns dividends, and when there are losses, the value of their share decreases. The mutual fund is managed by a professional investment manager, who is also called a fund manager or a portfolio manager. The fund manager buys and sells securities in line with the objectives of the fund. The fund manager's compensation is linked to how well the fund does, which motivates him to go the extra distance in ensuring that the fund does well. Mutual funds are the ideal way to diversify your investments. In fact, mutual funds have emerged as one of the best investment vehicles because they are highly cost efficient and easy to use. The cost of investment is spread across a large number of investors, making it much cheaper than investing individually. And you don't have to do a thing. Well, maybe just check on your fund value every so often. There are a couple of things to remember when picking a fund. There are essentially three types of funds. An equity fund invests entirely in stocks, a little more risk but also a little more reward. A fixed income fund is made of government and corporate bonds, which provide returns at a fixed rate. These are usually low risk but lower return as well. A balanced fund is composed of both stocks and bonds. They are generally low to moderate risk and reward. Another important characteristic of a mutual fund is whether it is open-ended or close-ended. Open-ended simply means that the investor can buy or sell shares in the fund whenever they want. A close-ended fund allows the investor to buy only a certain number of shares when the fund is initiated. They can only be sold back when the fund is terminated after a fixed period. Shares of close-ended funds can be traded on the secondary market though. The last thing to pay attention to is the load associated with the fund. The load is simply the sales fee charged by the fund. It's usually a % of your investment which can be charged when you buy into the fund, in which case the fund is front-loaded, or it can be charged when you sell, also referred to as back-loaded. The investor should also look out for low-load or no-load funds, which can be a great deal. With all the funds looking for ways to differentiate themselves from each other, there is a huge variety of funds available from well-reputed companies. But the most important thing to remember is that the fund's objectives should match your own as closely as possible. And don't let those confusing names perplex you. So this is it for today, and I'll be back soon with more news.